Okay, class, so this is where we left off on chapter 3. So just a reminder, this is chapter 3 on job costing. And we finished up with this slide where we talked about the flow of the costs. And when we do the journal entries, we want to consider that the journal entries will follow the cost flow of the manufacturing plant. So in other words, our journal entries will begin with buying raw materials and then uh, purchase recs for those for that inventory to go into the work in process, and then tracing the direct labor, allocating the manufacturing overhead, completing some of the jobs and putting it into finished goods, and then of course selling the goods, and that goes into cost of goods sold. So this is one of the few chapters that really has a number of journal entries, and they're not difficult. They all follow the same principle. So we begin with purchasing raw materials. And if you remember from financial accounting, we debit an asset when we're increasing it, so raw materials inventory, and we buy it on credit, so we're going to credit accounts payable. And of course, that's for $90,000 worth of raw material. Now, this is what's new, is that for a job order costing system, when you used a certain amount of direct raw materials in a job, and in this case, we used it in 2 different jobs, the controlling account, which is the work in process, and that is a inventory account, is debited. So notice that we have 2 jobs. Those jobs would be subsidiary accounts, and then the controlling account would be the work in process. And we would add those 2 together, and we're taking it out of raw material, so we'd be crediting the raw material account. So following the cost flow, we had it go into raw materials, and now we go into work in process. Now we also used some indirect materials, and remember that indirect materials and indirect labor is actually manufacturing overhead. And we are always going to debit manufacturing overhead for the actual amount, which means the amount used, and then later on we will allocate manufacturing overhead. That's when we credit it. So it's still raw material, so we'll still take it out of the raw material account, but because it's indirect raw material, and that might be something like nails or glue or something that's not easily traced to the product, we're going to account for that by putting it into the manufacturing overhead account. Now, remember that in accounting, words mean something. So incurred is the same thing as saying used. So $30,000 of direct labor. And again, we have 2 jobs that are going on, job 603, job 604. And again, we don't have a direct labor account. Instead, the controlling account, which is the work in process, or sometimes known as the WIP account. So we're debiting work in process for now the direct labor that we can trace to these 2 jobs. And again, the jobs are subsidiary accounts. The work in process is the controlling account, which means it summarizes all of the subsidiary accounts. And then the account that would go along with any kind of, in this case, labor would be wages payable. Indirect labor, again, is classified as manufacturing overhead. So indirect labor could be, for example, the janitor for the plant, or even a supervisor, a part-time supervisor who supervises a number of jobs, so you can't trace them directly to one job. So you would put the indirect labor into manufacturing overhead, and again, you would credit wages payable. Okay, incurring other manufacturing overhead. So this is the actual manufacturing overhead Remember that when we do the actual manufacturing overhead, that's when we debit manufacturing overhead. And these would be all the accounts that would be paired up with it. So you would simply have the electric bill comes in, we have depreciation, the insurance bill comes in, the property taxes. Okay, so we're accumulating all of these actual costs, and later on we'll allocate the costs to the jobs. Okay, so these are the manufacturing overhead costs, and again, recognize this time it doesn't say factory, but it says plant, and we know that that means manufacturing overhead. Now, at the end of the period, when it's time to allocate manufacturing overhead, and that's where we have that predetermined overhead rate. So remember, it was $16 per direct labor hour, okay? And we got that by taking the estimated manufacturing overhead divided by the estimated allocation base. And so for each one of these jobs, this job had 500 direct labor hours. So this is direct labor hours. And this one had 1,000 direct labor hours. So the total amount that we allocated was 24,000. And when we allocated it, that goes into the work in process. The credit is for manufacturing overhead. So again, when it was the actual manufacturing overhead, we debited it. When it's the allocated manufacturing overhead, we credit it. Okay, now, following along in the cost flows, we're now going to assume that this particular job, 603, and this job, 604, that they've both been completed. So we're going to put them into the finished goods inventory and take them out of the work in process. So when they're finished, we're increasing finished goods, we're decreasing work in process. When we sell it, okay, it's just like in financial accounting. Remember, when you sell something, you have two journal entries. One is for the sales part of it. So we're going to sell 40 cross trainers, which we go back to job 603, and that costs $14.25 to make. And we're going to sell 60 treadmills, and that costs $2,500. So the total amount of accounts receivable would be $207,000. Sales revenue, $207,000. That's the first part of the sales journal entry. And the second part is the cost of goods sold. And of course, this is where we determine that, if you remember back on, all the way back on job 603, we determined that the average cost for job 603 was $1,160. So there were 40 of those. And then job 604, which we didn't do all the calculations, the average cost was $1,800. So now our cost of goods sold is $154,400, and we take it out of finished goods because when we sell the inventory, we take it out of finished goods, and now we put it on the income statement as the cost of goods sold. All right, now the rest of it is just the same as any financial accounting problem. Operating expenses, you can see it's just simply this is the rest of the value chain. This doesn't have to do with the production, so it's not part of the cost flow. It's just the regular salaries expense, rent expense, marketing expense, all of the things in the value chain, and then the payables that match up with each of the expense. Okay, that's just remembering financial accounting. And of course, taking a look at this now, when you're doing this allocation, remember that's an estimate. So all of the indirect material, indirect labor, and other indirect manufacturing costs that we did on those other journal entries came up to a total of $25,000, we allocated 24,000, and so here we have a balance of a debit, which means that we underallocated the manufacturing overhead, because this side is the underside if this is the balance, and this is the overside. And so in order to zero out this account, because this is just an expense like any other time when you close out an account, so you debit your cost of goods sold and you credit manufacturing overhead for 1,000, and you can see what happens. Now we zero this out just like we would any kind of expense. And so because it was under allocated, we debit cost of goods sold and we credit manufacturing overhead, and we start the new period again with no balance in manufacturing overhead. Okay, so that's it for the PowerPoint slide. Let me see if I can move on.